I'm thrilled to be able to welcome four managing directors from Hamilton Lane. And as you see from the title, they're going to be sharing predictions for the future of the private markets. Cori English is managing director of Hamilton Lane's fund investment team, building portfolios and managing relationships for the firm's institutional clients. Keith Brittain is a managing director of secondary investment team, a member of the investment committee responsible for sourcing, due diligence, execution of secondary investments. Griffith Norville is managing director leading the firm's Cobalt LB business and co-heading the integration of the firm's monitoring and reporting and related advisory activities. He also focuses on data and technology initiatives for strategic investments and partnerships. Stephanie Strid Davis is managing director and co-head of the U.S. Private Wealth Solutions, responsible for leading the U.S. development team focusing on financial intermediaries and platforms. They'll be addressing three different themes, and we will be planning to have you put your questions in the chat, and we'll answer as we end each segment. I would like to transition to Cori and let her lead the program. Again, thank you. We welcome you and look forward to a very interesting and dynamic conversation.
Great. Thanks, everybody. Can everybody see my screen?
Yes.
Thumbs up. Great. So good morning. Thank you first and foremost for having us here today. We're really excited to be presenting to the Beacon Private Equity subgroup. As a Conshohocken, Pennsylvania headquartered firm, we're always looking for ways to expand our partnerships and relationships locally. So we really do appreciate the opportunity to be here with you today. As Georgine said, I'm a managing director on the investment team. I've spent the last 15 years in Hamilton Lane managing some of our institutional client portfolios. And I have the good fortune of being joined by many of my talented colleagues in some of the fastest growing areas of the private markets. Keith in secondaries, Stephanie in private wealth, and Griff in sort of strategic technology. So I thought it'd be helpful to spend just a couple of minutes on the firm as a backdrop for the conversation so that you can really understand who we are and what we do. Over the past 30 years, we've built a business that is centered around our investors and our partners. And that means that we build private market solutions. And that centers around asset classes, private equity, private credit, real estate, and infrastructure. And we build these solutions in a couple of different ways, through separately managed accounts, through commingled funds across a variety of strategies and sub-strategies. So think secondaries, direct equity, credit, infrastructure, impact, evergreen, which is a huge area of focus, and really the reason behind our private wealth growth. And Stephanie's going to talk about that today. And then lastly, we also partner with clients in an advisory capacity, providing data, analytics, reporting, and technology services for our clients. We have about 830 billion of assets under management and supervision, about 600 people in 22 offices, investing and overseeing that client capital. And I think one of our biggest differentiators is that data, technology, and information. In an asset class that you all know has been infamous for a lack of transparency, we think we have some of the richest data and the widest data in the industry. We monitor more than 50,000 private markets funds, 130,000 portfolio companies, and we have about 65% of those companies we have actually operating metrics on. So really rich data set. And that's a competitive advantage for our clients. It fuels our research engine. It enables us to make better decisions. And what we're presenting for you today is the direct result of that data set. It's real thought leadership around the future of the private markets. So today, what we're going to present are three reasonably outlandish predictions for the future of the private markets and what the private markets look like in 10 years. And so given some of the background of our presenters today, you can probably guess some of the areas of focus, and at the risk of stealing thunder from anyone, I think I'll turn it right over to Keith Brittain for our first reasonably outlandish prediction. Keith.
All right. Thanks, Cori. So prediction number 1 of 3 is secondary transaction volume will exceed $1 trillion in 10 years. And if you think about why the secondary market exists, it exists to provide liquidity to investors that commit to private equity funds, right? So if you invest in the stock market or the bond market, right, you can sell your shares in Apple or Comcast basically anytime you want, right? But if you commit money to a private equity fund, it's a 10-year lockup. So if you want to sell your commitment in year 3 or 5 or 9 of that 10-year commitment, there is no formal market to sell your basically your LP interest in a private equity fund. So you as an LP have to go find a buyer, you have to negotiate a price, and you have to go through a fairly lengthy legal negotiation process. So if you rewind 15 years ago, the secondary market was really, really small. It was about $10 billion of transactions. There wasn't much press about the secondary market. Not many people really wanted to build a career in secondaries. It was really, really small. And if you fast forward to today, it has been one of the fastest growing, if not the fastest growing segment of all of private markets. So with that as a backdrop, Cori, maybe if you flip ahead a slide, you can see here historically what secondary transaction volume has been. Again, back in 2009, $10 billion, 2021, $132 billion. So what we're predicting in this reasonably outlandish prediction is that in 10 years, secondary volume will grow 7 times from where it was in 2021 to $1 trillion. And if you flip ahead one slide, what that means, if you look historically over the prior 10 years, secondary market volume has grown 5 times. So certainly 7 times in the next 10 years is higher than what we've seen over the prior 10 years. But by flipping ahead one more slide, you can see looking back 12 years, the market has grown 13 times. So when you think private markets and when you think secondaries, it has historically been very small. It is becoming increasingly larger and a much more important part of private markets. And as you think about how investors in private equity allocate their dollars, some of those go to buyout funds, some to venture funds, some to growth funds. You are seeing a big chunk of those dollars go in the secondary funds to create liquidity for investors. And so the next obvious question is, why has this asset class grown so much? I think if you flip ahead one slide, what we show here is the overall private markets net asset value. So if you look through the books of all private equity funds, or basically all investors in private equity, there is about $7 trillion of capital in the private markets. That line has been sloping upward and to the right. And all of these dollars, all $7 trillion, is basically a chance for a secondary, right? If any one of these dollars wants liquidity, so if a pension plan or a college endowment fund or a hospital system wants liquidity, they can approach the secondary market to get that. So this is the inventory. This is one of the reasons why secondary volume has grown so much over the past 10 years. The second biggest growth driver is what you see here, and that is really the market has evolved. And it has evolved more so than any other asset class, right? A buyout deal is a buyout deal. A venture capital funding is a venture capital funding. If you rewind in the secondary market to 2009, and we illustrate that here with the Model T, right? There was one type of secondary transaction. If you're a pension plan and you were over-allocated to private equity or you were distressed, then you could sell your LP interest to Blackstone or KKR on the secondary market. If you fast forward to today, there's essentially 2 types of transactions. You see on the right, LP deals, that is essentially an investor in private equity looking to sell their commitment to a private equity fund. There are various types of those LP deals. There are tenders, portfolio solutions, funded primaries. The other half of the secondary market today are what we call GP-led transactions. These are when a private equity fund has an asset or a few assets, or maybe all assets in a fund. They sell those assets out of their fund into a new vehicle, capitalized by the secondary market. So you often hear private equity funds say, I've got a great asset. I have a 10-year fund life that I need to manage to, and I've got to sell this asset because my investors want me to manage a 10-year fund life. And I'm mad because I'm going to sell that asset to another private equity firm who's going to make 2 or 3 times their money. We're seeing private equity firms now being able to hold on to that asset longer, particularly their better assets, by selling it essentially to themselves in a deal that is capitalized by the secondary market. That transaction didn't exist 15 years ago. It exists today. So as you think about what the future state of the secondary market could look like, there could be transaction types that we're not even thinking about today. And those two things are the biggest reasons why the volume has grown. I think if you take each one of these deals separately, if you take LP deals specifically and flip ahead one slide, you will see that what you have today is virtually every limited partner type in private equity has sold. They have used the secondary market. It is a much more robust market today than it was 10, 15 years ago. Again, 15 years ago, the main reason why investors in private equity funds sold was because of distress. Today, the main reason why investors in private equity funds sell is portfolio management, right? Maybe a hospital system or a college endowment fund is overallocated to venture, so they can now use the secondary market to scale back their venture exposure. There's a lot of portfolio management reasons why LPs use the secondary market. The second big takeaway from this slide is when you look at the bottom, half of the sellers last year were first-time sellers. And if you think about that, there are thousands and thousands and thousands of limited partners that commit to private equity funds every year. Half of them were new to the secondary market. And there's not a great number on this, but the best estimate is that only 200 limited partners actually sold on the secondary market last year. So if you think about that, you've got 200 sellers and thousands of potential sellers. So as we think about what the secondary market can look like in 10 years, why can't 500 LPs sell? Why can't 1,000 LPs sell? I think they will. And I think as more retail investors come into private markets, you will have a much more active secondary market. So that's the LP side of the equation. If you look at the next slide, the GP side of the equation, again, this is the second type of transaction where private equity funds are selling an asset or assets basically to themselves in a new vehicle capitalized by the secondary market. And you see the volume in this type of transaction in the dark blue bar. And if you look, for example, in 2014, this market it was so small, no one really kept track of it. And you can see these types of transactions have grown close to 50% annually. And in 2021, for example, GP-led secondary volume was bigger than the entire secondary market was just 4 years ago in 2017. So why has this happened? Well, if you flip ahead a slide, what we're seeing is if you think about how private equity firms exit their portfolio companies, it is through the public markets, it is through selling to another private equity firm or selling to a strategic. Now, with the secondary market and these GP-led transactions, private equity funds have another path to get liquidity from their companies, and that is using the secondary market in what we call GP-led secondaries. You can see on the left, we did a survey of private equity firms. The takeaway is that they like this product a lot because it gives them another option to exit their portfolio companies. I think what you see on the right is that over time, the exit path of the liquidity options has increased tremendously, but in the grand scheme of the private markets is still relatively small. So only 3% of all distributions to limited partners have come from these types of transactions. So if you bring it all together on the next slide, what we show here is essentially secondary volume divided by all of private markets net asset value. Think back 5 or 6 slides ago. So essentially between 1.5% and 2% of all private markets transacts on the secondary market each year. And if you think about that, if you think about private equity as an asset class, it has outperformed public markets. And so the question is, well, why aren't more limited partners committing more dollars to private markets? And the reason is this, because historically there has been a lack of liquidity. So if you commit to the private markets, it's more illiquid, it's a long duration, it's a long lockup. But I think what you see from this chart is that over time, there has been more liquidity. And I think as the secondary market gets bigger and more robust, more capital will keep flowing in the private markets because that liquidity will be easier to get. And so when you look out 10 years, could this turnover rate be 3%, 4%, 5%? I think so. And that more liquidity will bring more LPs into the asset class. And think about as the retail channel begins to commit to private equity, right? They're used to trading on the stock market every day. I think that will help drive liquidity in the private markets. The next obvious question is, what could hold us back? And I think what you see here, the short answer is capital constraints, right? The secondary market is undercapitalized for all of the deals out there, right? There are a lot of limited partners that want to sell. There are a lot of private equity firms that want to do more discontinuation funds, but there's not enough secondary capital to do all of these deals. And you can see that on the left, which is the dry powder ratio, right? This measures dry powder that all the secondary players have compared to deal volume. And you can see that dry powder in the secondary space is lower than the buyout space. And when you compare venture and growth, its secondary volume or secondary dry powder is lower than unfunded capital in all those areas. And I think we have made tremendous strides as an asset class in raising capital, and you kind of see that on the next page. This slide kind of blew my mind. If you look back to 2007, right, and if you look at the top 10 private equity funds raised in the world, none of them, secondaries weren't even a blip in the top funds. Fast forward to today, the largest secondary fund raised is almost as big as the largest buyout fund raised. It just shows you how fast the asset class has grown and how much opportunity there is. Like when you look forward and you look out 10 years, could there be more blue bubbles than orange bubbles? Perhaps. I think the market will keep growing, but what's holding it back right now is just the capital constraint. So if you flip ahead one slide and come back to our prediction, right? Again, we're predicting that in 10 years, secondary market will grow to $1 trillion. How do we get there? And if you flip ahead one slide, you get there really from a few things, right? One is, what is the private market's net asset value and how fast will that grow? And what is the turnover rate? So I think if private markets continue to grow at 15% annually, like we have seen in the past, then the turnover rate only has to be about 3.5% to get to that $1 trillion. So where do we go from here? I'll just wrap up. And I saw a few questions come across. I think when you think about private markets and you think about the secondary market in particular, we think there will be greater market acceptance, right? Limited partners 15 years ago rarely sold in the secondary market. They're selling a lot more in the secondary market today for various reasons. And now you have GPs, private equity firms that are also using the market to their benefit. I think when you look out 10 years from today, there's potential to have many new types of secondaries, which will keep driving the market. And I think as the overall asset class grows, our inventory keeps growing, and with that, will drive secondary market liquidity. So that was really it with prediction one. I did see a few questions come across.
Keith, we had a couple of questions. I mean, I guess one question I had was, I mean, with the exception of continuation funds, I mean, when people are selling in secondary, is that typically seen as a sort of a semi-distressed situation? I mean, are they being traded at a typical discount, or how's it perceived, I guess, in the market?
Yeah, I think you're right. So 15 years ago, really, that's all you saw was distressed sellers using the secondary market to trade. Coming out of the global financial crisis, 2010, 2011, then you had a lot of new regulations came out that forced banks, for example, to sell. They weren't distressed, but regulations came out that required them to scale back their on-balance sheet commitments. And from there to today, you have seen just a lot more reasons to sell. And the main reason why investors sell today is really just portfolio management. Distress is no longer a reason to sell, although you could, but the biggest reason is just portfolio management, right? You're over allocated to private equity, you need to scale back, so you use a secondary market. Maybe a new CIO comes in and doesn't like what the old CIO bought, so they sell everything the old CIO bought and build a new portfolio from scratch. So there's the perception has changed from distressed to now acceptance. And I think that perception will continue to change more and more as we go forward. I did see a question around discounts. I think discounts are a function of a number of things. If you look at the secondary market, call it 2 years ago, discounts were very thin. The private markets were upward to the right. M&A markets were booming. IPO markets were booming. That created a scenario where I guess secondary discounts were maybe 5%, 2%, some cases 0%. When you look at where they are today, right, there's more uncertainty. M&A markets aren't as robust. IPO windows closed. Discounts today are much larger, maybe 20%. So discounts are sort of cyclical with the way that that the economy is and the way the public markets are. And as a result, right, there are bigger discounts today than there have been in the past number of years.
Great. And yes, Stephen had a question in the chat. Is it assumed that the secondary market will be as sophisticated as the buyout market? And isn't it possible there will be a need for the market to be regulated or maybe more regulated than it is?
Yeah, I think, is it assumed that the secondary market will be as sophisticated as the buyout market? I think it will be. I think you have very sophisticated folks in the secondary market. It's a different type of analysis, right? So the analysis that we do as buyers, so we're buying into essentially a buyout fund in year 4. That is a much different analysis than a buyout fund looking to invest in a company and hold for the next 5 to 7 years. So sophistication for sure is there. It's a different type of analysis. And I think what you see and what you have seen in the secondary market is a ton of sophistication, not only around investing, but creating new markets, right? That GP-led market, for example, didn't exist really 7-8 years ago, and it exists today, and it exists in a very big way. So I think that the evolution will keep going as a result of the sophistication of the participants.
All right. Well, if there's no more questions for Keith, I think that's the perfect lead-in for our prediction number 2. Allocations to the private markets will be 50% of portfolios. And Keith gave us the lead in with talking about really just the acceptance and the growth of the secondary market. But many of you on this call might be thinking, never in a million years could this really happen, or never in a million years am I going to have 50% of my portfolio in a private market allocation. And our CEO, Mario Giannini, has been making this claim for over a year now. And Cori and I we presented this prediction to a board a couple of months back, and we did get some criticism from some of the academics, public markets, and some hedge fund people in the room. And we wrote down some of those criticisms and evaluated them in the context of our own data set. So said a little bit differently, some really intelligent people out there have a lot of misconceptions around the private markets, and these misconceptions that are rooted in a lot of just those media headlines that they're seeing or clickbait and a lot of emotions that they have around their portfolios and their allocations. And some of them are just factually wrong or incorrect.
So I think today what we want to focus on are these commonly held misconceptions, and really just imagine the possibilities that if we were using facts and data to fuel decisions around portfolio allocations, could we change these misconceptions? And just remove the emotion and excuses around it's too illiquid, it's too risky, the performance isn't going to continue. Then maybe a 50% allocation to the private markets wouldn't seem so crazy. Endowments and foundations in the US have been at or above 50% for years. A number of our public pension funds in this country aren't that far off from 50% when you aggregate all their private markets exposure, right? Private equity, private credit, real estate infrastructure together. So let's start with misconception number 1 from this board meeting. You can replicate it being private equity, by levering a public equity index. We hear this one all the time, and there's a lot of things wrong with this, so we'll take it one by one. First, private equity tends to be a better form of governance than the public markets, which is why it is a growing universe and, in theory, a limitless opportunity set with new private companies being formed every day, in comparison to the public universe, which is shrinking, especially here in the US. So it really begs the question that if you, as an investor, if you're not in the private markets, are you really getting broad exposure to the economy? We think the answer is no. Globally, there's about 95,000 privately held companies with revenues more than $100 million versus 10,000 publicly held companies with similar revenues. So that's 9.5x the size of the universe, of the public universe. And you can see that irrespective of geography, private equity represents a target-rich universe, dramatically larger opportunity set. From an exposure perspective, you can't replicate that. So let's address the second piece of this misconception, which is around the performance. Here we've taken, we're looking at the public market universe. We've taken the S&P 500 with 2 times leverage and ETF and compared that performance to an all private equity index here over the past 15 years. You can see private equity, the blue line, outperforms over every year. So we don't buy it. You can't replicate private equity's exposure, and you certainly can't replicate its performance even with leverage.
All right, well, that moves us on to our second misconception that we hear quite often for the private markets. It won't outperform. And there is the little spoiler alert that it really always has, and it probably always will. So Cori, if you can switch to the next slide, we'll take a look at some of the data. Let's look at this slide at the last 5 years in what was really unarguably one of the greatest bull markets probably in history. And if you take a look at the growth of $1 here, if you invested $1 into public equities from 2018, so that dark blue line, you would have gotten back $1.23 by the end of 2022, which really isn't bad. And if you do the same thing with the same dollar and put it into private equity, that same dollar would be worth $2.24, which is that light blue at the top here. So if you flip to the next slide, let's take a look at this on a 10-year rolling time-weighted return basis. Generally, the light blue line, which represents that all private equity, it really does stay on top regardless of the benchmark that it's compared to, and through different cycles and political environments, bringing this chart all the way back to 2018. So none of that is probably super surprising to you. So let's take a look at this actually from a little bit of a different lens. So on this chart, you can see this is our 60-40 portfolio allocation slide. And what if portfolios really were 50% invested into the private markets? And if you took the traditional 60-40 portfolio, which is on the left, and replaced 35%, okay, of your public equity exposure with private equity. And if you took 15% of that fixed income exposure and replaced that with private credit, and that would give you your combined 50% overall exposure to the private markets, which is that box on the right. And the answer is you'd have nearly 350 basis points of outperformance with significantly lower risk, given then also the differential in the Sharpe ratios. So really, bottom line here on the allocation piece is a larger allocation to the best performing, best risk-adjusted asset class in your portfolio is going to drive total portfolio performance.
Which is a nice segue to our third misconception, that it's too risky. Let's actually start with the public markets here as a backdrop by way of comparison. When we talk about risk in the public markets, we don't make broad sweeping generalizations about risk. We don't lump all the strategies together, right? We talk about small cap growth, small cap value, large cap growth, large cap value. We look at sector focus indices like tech or energy. So why then in the private markets are we strategy agnostic when we talk about risk? We tend to lump it all together and say private equity is too risky without thinking about the strategy and the underlying exposure to various geographies and industries. So as you can see here, this is the risk return of all strategies in the private markets, and you can see that they're quite different. Here we're looking at risk as a measurement of annualized de-smoothed volatility. It's quite a mouthful. De-smoothing in the private markets helps provide a measure of implied volatility, which of course is difficult to measure given the quarterly valuations that we're subject to in the private markets. But the takeaway here is that not all risk in the asset class is created the same. So now let's look at each strategy's worst 5-year period of performance. There's a lot of data on this chart, but what you can see here is the quarter end date represents the last quarter of that worst 5-year period of performance. So what are the takeaways? Developed market buyout and the private, or I should just note that the private market strategies are in blue, the public strategies are in orange. Takeaways: developed market buyout still returned a 2.5% return after the tech bubble. Private credit's worst 5-year period of performance is 4.6%. That's unbelievable. Some of our real asset strategies, while they lost money relative to the public markets, they're generally not as bad and certainly not drastically worse than the publics. The only strategy that was significantly worse than its public market comparable was venture capital and growth equity. Not surprising to us, we all know that venture tends to be a riskier strategy. And then the last way we'll talk about risk or examine risk is through the risk of catastrophic loss, which here we're defining as a 70% decline from peak value with minimal recovery. So 40% of public market stocks experience a catastrophic loss, as compared to 18% of private equity buyout deals. When you think about catastrophic loss at the fund level, which is how most investors come into the asset class, and you have obviously the benefit of diversification, it's an even smaller risk with 2.8% of buyout funds experiencing catastrophic loss. So I think the big takeaways here are that not all risk in the private markets are created the same. And even in their worst periods of performance, compared to the public markets, your risk of loss is much less than in the public markets.
And this brings us into our next, or our last final criticism that we got about our prediction was that the private markets, they're just too illiquid and they're really too difficult to access, or really are they? Illiquidity, we know, is one of the major perceived risks when making an investment into private markets as an asset class as a whole. We did just hear Keith talk about the growth of the secondary market, which we know is really a tremendous source of liquidity in the asset class. And what about distributions? So mature private equity programs do generate significant cash. The average PE portfolio makes cash distributions that can be equal to NAV in approximately that 4 to 5 year period. And through really even thoughtful portfolio construction decisions, you can design portfolios that can be designed to provide even a greater cash yield. And there's other solutions to help out there with liquidity as well in this asset class. We've seen the advent and rise of these semi-liquid structures, which you probably have read about in the press or have heard about, which do generate liquidity for products in different ways. These structures, as you can see, tend to offer funds, interval funds, BDCs or business development companies are becoming more popular as they fit the needs of those private wealth investors a little more nicely than those traditional 15-year locked up funds. The major appeal of these types of we'll call them semi-liquid vehicles lies in their ability to meet redemption requests more regularly than, say, those traditional, like I said, closed-end funds. So in really the simplest terms, investors are allowed to pull out their investments on, say, a quarterly, semi-annually, sometimes annual basis. And the frequency of repurchases may vary by fund or by structure. But really, these different semi-annual, evergreen, semi-liquid structures are becoming more and more appealing, especially in the private wealth space, which is the space that I travel in. And it's a space that really didn't exist in this market even 10 years ago. So along with these structures that offer more liquidity, they also offer a more user-friendly experience with the emergence of some, we'll call them technology or alternative investment technology platforms such as iCapital, Case, Moonfair, and Plus Subscribe. So let's take a look at the next slide and talk a little bit about the accessibility piece to this. These semi-liquid structures, as you can see shown on the right, really are enabling a broader access to the private markets for investors overall. In these semi-liquid structures, an investor can subscribe monthly. They can be fully deployed on day one with no capital calls, which is a huge bonus. Minimum investments are typically a lot lower than, say, your traditional closed-end fund. And I talked a little bit about the improved liquidity that these types of structures offer. Tax reporting is simplified. Typically, sometimes you get a 1099 rather than the K1. And the subscription process, as I mentioned, is a lot less cumbersome. So you don't have to fill out, 160 plus subscription document. Usually it's just a 1 or 2 page application for these types of structures. And there goes the dog. He had to bark at one point on this presentation. But let's take a look at the next slide quickly, Cori. As you can see here, these registered structures, they're gaining popularity, and they're gaining popularity very quickly. If you can look at where registered PE fund AUM was in 2010, even compared to where it is today, and that trend keeps going upward. So the typical high net worth investor now really does they have better access to the asset class. They have an easier mechanism to purchase these structures that offers some measure of liquidity. So maybe the average single digit allocation to the private markets does get us to that 50%.
Stephanie, how obviously, if you're an investor or fund and you're investing in the public markets, you can look at a particular stock, Tesla, Google, whatever it is, you can do your research and you can get exposure to that. I mean, the majority of private equity assets sit in funds, and you can obviously invest in the fund, but you don't necessarily have control about what the fund's investing in and what you're really getting exposure to. So how, as an investor, if you want more exposure to the private markets, can you sort of drill down to particular investments? Or I'm guessing that's not very easy at the moment. Do you think it's going to get easier? Or
well, it depends really on what the fund or the product strategy really is investing in. So the trend in today's world is you have all of these interval funds, tender offer funds, semi-liquid, evergreen products with different strategies underlying them. So Hamilton Lane, for example, we have a product that is a semi-liquid product, but we'll call it multi-strategy. So it invests in direct transactions and secondaries, direct credit, and direct equity, giving you that broader strategy subset. There may be funds like a BDC or other funds out there that are solely investing into credit. So it really depends on the underlying strategy of a specific product that you might be investing in. And as you can see, even on this slide alone, the trend going upwards is there's going to be more and more options made available to high net worth investors in these types of structures. The market's growing really, really rapidly.
So I think, the conclusion here for this prediction is, if we could change some of these misconceptions, if we could sort of remove the emotion around the illiquidity, the risk, the underperformance, why wouldn't you allocate more dollars to the best performing asset classes in your portfolio?
And really, again, to point to, innovation and technology in this space is really driving this industry forward. It's enabling investors that typically may not have had access to these types of products and strategies now do in a really user-friendly, easier format. Someday, we're still getting to the era of point and click and DocuSign for some of these things, leading us even into what Griff is going to talk about a little bit, which, who knows, maybe even someday you can click and point on your phone and make an investment into the private markets.
Great transition. Thanks, Steph. So I'm going to spend a bit of time on this title slide to give a little bit of a context for our next outlandish prediction. Although the title here does really give away what the prediction is going to get into, and the word blockchain, I realize, has lost a lot of luster. But let me try to give you perspective on how we are thinking about it and how we think it might change this industry for the better. So you've also heard a lot of great things about our industry from the prior two presenters. Great presentations, by the way, great predictions. But I want to start with the negative, what the major challenges that remain in this industry are that are preventing us from scaling. I really do think that we have huge problems when it comes to operational inefficiency. This is a market built for large institutional investors for the most part. You've heard about a lot of the future of this industry from my colleagues around reaching into the high net worth channel. But unless we solve some of the inherent challenges that we have in this industry, I feel like that's going to be a hard thing for us to do, right? There's friction here at every point of the investment life cycle. preventing higher volumes of capital flowing in, which is what Cori and Stephanie were predicting, preventing secondary transactions like Keith was predicting. So if you think about subscribing to funds, and I know we've talked a little bit about it, and there are groups like iCapital and Case making it a little easier, as Stephanie was speaking about. But for the majority of the industry, subscribing to funds is still time consuming, it's slow, it's expensive, it's complicated. You're filling out pages and pages of documents each time you want to invest. And this is done for a reason. We have important anti-money laundering and know your customer checks. We need to pass the compliance, regulatory, and risk checks to ensure that the capital coming into to funds in this asset class are appropriate. But no two funds have the same process. So we have an asset class that's hard to get into. And when you think about selling something, Keith was talking about selling on the secondary market, good luck there. You need a broker, you need a group of lawyers. So it's not fun in either respect to get in or out. And so we've often compared, especially on the performance side, public markets to privates. But the real truth is private markets are a younger asset class and way behind public markets in terms of adding technology, adding efficiency, and how you access and manage your portfolio. So we're playing catch up, but we are improving rapidly. That's all the bad news. The good news is there's a group of entrepreneurs out there that are doing a lot of great work. And you have groups like Hamilton Lane. So now I'll toot our own horn here before we move on. Hamilton Lane has dedicated themselves to, we've dedicated ourselves to investing in technology and the use of data in the private markets. We think that we are built differently from other asset managers in this space, other investors in this space. We spend a ton of time talking about, thinking about innovation, investing in it. We've got groups within the firm here of data scientists, data engineers, software developers. We look very different from some other investors in this asset class. It's a crucial part of who we are. We have a strategy internally called Hamilton Lane Innovations. We take balance sheet capital, not client capital, but this is capital off of our balance sheet. We invest it in market leading technologies that are changing the way this asset class works. We've done that 15 times over, taking money off our balance sheet, investing in groups where, you know, we get to use our voice to influence how that technology is built to benefit us, to benefit our clients first and foremost. We've always got an eye on our clients here, and to really elevate this industry to solve some of these inherent challenges we have. So let's move into our third prediction, the blockchain, right? So imagine when subscribing to an investment is as easy as opening up your fund and hitting the buy button, or selling an investment as easy as opening up your phone here and hitting the sell button. Well, then I would think that the prior two predictions are conservative in nature. So I'll say my colleagues were too conservative. Only 50% in the private markets, only $1 trillion, Keith. I would say we can easily surpass that when it becomes as easy as hitting the buy button. And the blockchain is one vision for how that might happen. And we are starting. This is here. So let me tell you a little bit about how we've been democratizing access to the private markets through the blockchain, creating private markets for the people, not just for institutions, importantly, right? And I will say that this is not cryptocurrency. So if you're not familiar with the difference between blockchain and cryptocurrency, I wouldn't actually claim to be an expert here, but cryptocurrency has been sort of the Wild West in the use of the blockchain underlying technology to create investable securities. And we've all heard about the problems with FTX and some other groups. This is not crypto. This is not cryptocurrency. What we're talking about here is blockchain technology, and the groups that we have been working with, the groups that other groups within private markets have been working with, groups like Addicts and Securitize that you'll hear about later. These are groups that are regulated by governments that are seeking to protect investors. We're working with, using the blockchain technology, regulated entities, trusted and experienced entities in this asset class, and taking a different approach than many of the crypto approaches that you might have heard about. So tokenization, we do have to have some definitions here while we stick on this slide. So tokenization, actually, Cori, we'll just stick here. So tokenization is literally offering a digital access point to an investment fund. And so what it's doing is it's providing efficiency to the investment process. That efficiency effectively is able to allow groups like us to lower investment minimums into our funds, making our funds more broadly accessible to a broader number of investors, right? So through tokenization, we'll effectively streamline the subscription process. So instead of making those cumbersome 20 separate fund commitment document, the filling out of the documents 20 different times, you will fill out documents once, and then you will have the ability to hit that buy button and subscribe 20 times over through the use of tokens. What we're talking about here is opening up a lot of interesting possibilities. And then on the liquidity side, tokens can be broken down into smaller pieces. And theoretically, they can be sold on the private market once we get a higher volume of participants in this network with fewer restrictions and much less friction. So the blockchain itself, it's a decentralized database. It's secure. It adds a ton of operational efficiency if used right. And if we are doing it in connection with and cooperation with the regulatory bodies to protect investors. So for the next page, we'll dive a little deeper. For those that want to get a little bit more technical, I will still try to keep it pretty high level. But let's talk about how this works in a bit greater detail. You do see two or three, actually you see three brands on here. I would highly recommend, if you're interested in more information, you reach out to Addicts, Securitize, Figure, you go to their websites. These are the groups, apps that are operating this technology. We are not operating it internally. We've chosen to partner with and sometimes invest in groups like this to get connected. I would say that, we've taken the easy way. So there's really two ways that asset managers can choose to get involved with the blockchain. One is they build their own blockchain. I wouldn't know the first thing about that. What we've done is we've taken the easy way, where there is blockchains being built by groups like this, and we are partnering with them. So they would be the primary point of contact if you were further interested in checking this out, making investments in this way. They are running active platforms that are investing using tokens. These platforms are not always available to US investors. Some of them are, some of them are not. Also, they still have often the same restrictions in terms of sophisticated, qualified investors that are the only ones that can utilize these platforms. So, I would relay further questions on exactly, how to get access to them directly. But in these cases, let's talk about Addicts and Securitize. What they're doing is operating an ecosystem where they can collect smaller investment minimums, maybe $10,000 USD, to get into a private market fund. That is somewhat less than 10% of the total investment minimum that someone like Hamilton Lane might normally accept, right? It is not efficient for a GP typically to accept investments that small and run through all the cumbersome AML, KYC, and other operational processes. But through Addicts and Securitize pooling together smaller investors through the use of tokens and then making a single commitment into a fund, it becomes much more economical for a GP to accept that investment. And importantly, groups like Addicts and Securitize, they've been around for a while. Addicts has been around doing this since 2017. So this is not new necessarily, but it's something that a lot of people have invested a lot of time and effort in order to protect the investor, and have built up an ecosystem here that is now in use. So this is happening today. Figure is a different style of it. What Figure is doing is actually launching, instead of a token pointing to an asset that lives in real life, which is what Addicts and Securitize is doing. What Figure is doing is actually creating a share class that is digital on the blockchain itself. So a subtly different way of doing it. But I would say that if you're interested in either of these, go ahead and check out the websites. But if these things are able to take off, and it's still, a bit of an if, but we're making outlandish predictions today. If these are able to take off, I would say the prior two predictions are conservative in nature. So that's it from me. Any questions on that material?
That's slightly adjacent question from Bob. He said, speaking of blockchain, what if will the impact of the eventual central bank digital currency have on sort of PE in the economy? So pretty big question there from Bob. But
Yeah, it might be out of my wheelhouse. I don't know. I don't have a crystal ball for that one.
I mean, do you see, is there going to need to be regulations around, this area really? I mean,
We absolutely think that, well, certainly it seems like the regulatory bodies are still playing catch up in a lot of ways. Addicts and Securitize, Addicts, let's talk about them specifically. They're based in Singapore, and the Singapore government is trying to be a leader in this space, devoting a lot of time and energy and thought leadership into how to protect investors. And so, they are supporting groups like Addicts, working with them very closely, which is why we think that is a better partner for us to target and experiment with today, versus operating in a space that does not have regulatory attention.
Question generally for all the areas, are you capturing any data on the demographics of the high wealth investor? Because I got to believe that, like, back to your board comment, that there were people with misconceptions. Is there any specific generation, age, that you're seeing? Or is anybody even capturing that?
Steph, do you want to talk a little bit about sort of the underlying private wealth investor and sort of the qualified investor and what that means?
Yeah, I would say in the private markets, especially for, we'll say, the products that Hamilton Lane is managing, there's qualifications that investors have to meet to invest into our funds. They range from that qualified purchaser, which is up here, all the way down to qualified clients. So not quite that mass affluent retail investor that invests in our products, more of that, 2 million and above, we'll say, in net worth. The demographics are a little all over the map. From on the institutional side, you have foundations, endowments, pensions, large institutional investors, all the way down to those high net worth that will say, average net worth is 2 million. Demographically, I would say age 45 and above. And we do capture some AML information on those investors. And we work with platforms on the high net worth side. Think Merrill Lynch, Morgan Stanley, those types of intermediary clientele, to registered investment advisors, family offices, and some private banking clients. So it really, really runs the gamut.
Yeah, be interesting to get your views on the debt markets. I mean, obviously, we've seen a number of distresses in regional banks and pullback from them lending, and other institutions as well. I mean, is this an opportunity that you see? Are you playing a bigger role in the sort of debt markets or debt funds and that sort of thing? Or
it is, Andy. There obviously the what we're seeing in the debt markets, it is very hard to get syndicate deals done, right? So as a result, you're seeing exits slow down for sure, particularly at the larger end of the market. I'd say where we're seeing exits across our portfolios is in the smaller companies, because there is a lot of private credit out there, a lot of private credit funds out there. So smaller companies can get financed on exit, and so that's where we're seeing the exits. We do have credit funds at Hamilton Lane, so we are playing in that space. We do think with banks exiting and certainly slowing down their lending and tightening their standards, there is a huge opportunity for private debt. And we're seeing that. We do have products around that, and it is the deal flow in that segment of our markets has been tremendous in terms of incoming deals, just because there is that lack of capital from banks.
Hey, I've got a question. And I think Griffin may have actually effectively answered it, but what was the logic of stopping at 50% with all the metrics that were laid out? Is that just part of the journey to get to a higher number in 20 years or something? Or is it that there's a liquidity issue and then that's a logical stopping point for somebody with a portfolio?
You mean on the allocation side?
Yes.
Yeah. So I think allocations across the private markets vary very drastically, right? Private wealth is brand new. I mean, Steph's title as U.S. head of private wealth didn't exist at Hamilton Lane 3 years ago. And we think that is a massive, massive opportunity set. So Mario, our CEO, said that about both the private wealth and the institutional space, sort of the average allocation. So the average allocation on the private wealth side is nowhere near 50%. It's 2, 3, 4%, right? So on the institutional side, obviously, where this has been an asset class that's been in existence and in portfolios for years and years, that's not as big of a stretch.
And I think to Cori's point on the private wealth side, institutions are very familiar. They're typically more sophisticated. They understand the market better in the private markets. On the high net worth side, we're seeing a trend in the market of education, making sure people really understand how these markets work, how these new structures work. A lot of these structures, I mean, I'm not going to say they're brand new, but newer in market with bigger, more commercial players that really have a name brand in the high net worth space. So, I mean, the trend, the typical allocation for a high net worth investor now is under 10%. But it's growing. So as I think these new structures come to market, they become more widely known. They have longer track records, and there will be more of them. I think those allocations are definitely going to continue to get higher.
Well, just again, want to say thank you again for this opportunity. It's been great to spend the morning with you, and really pleased to be here. So thank you again for the opportunity.
No, thank you, Cori. Thank you, Cori, Griff, Stephanie, and Keith. No, it's been really enlightening. Really appreciate your time.
Beacon is the premier executive networking organization serving the Mid-Atlantic region. To learn more, go to beaconforlife.org.